Good morning. Welcome to the B.F. Anderson Technical Report for May 21st. Last week we talked about how the data was providing us with evidence of a final bottom, which would be May 23rd. March 23rd. It's already May. But the point being is that this is not based on opinion. This is not based on anything more than just being aware of the fact that the market has come down, made a major sell-off on very heavy volume, lots of new lows, lots of pessimism. And so the question is now we've gotten a golden cross on the NASDAQ, which is the 25 above the 50. Now, up until this point, I really haven't paid attention to golden crosses of daily moving averages. But after going back and studying multiple bottoms of the last 50 years, I do think there's some meaningfulness to it, and I think we should pay attention to it. Now, on the weekly, you can clearly see that we're above the 35-week moving average, which is very similar to the 200-day. We've been above this level now for 6 weeks. Now, the rule is for you to get a buy signal on this indicator, it just takes 2 weeks. So now we're into the 6th week. So it does look like this particular indicator is saying something like, hey, you may have put a bottom in. Now, this is the small caps. As we know, the small caps have been underperforming for an extended period of time. If the small caps start outperforming, that's going to be a really positive sign. But right now, we're still on that death cross, and it's the group needs to improve. Now, the small cap index could be because there's a lot of small cap financial companies in the index, could be kind of causing this. But like I say, we want to see all these indexes. We want to see all of them improve because that means we're in a broad bull market. Right now, the market, though, is very narrow. You've got to be a stock picker here. Okay, here's the S&P 500. We're seeing some improvement here, back above the lower moving average. We're still on a golden cross. The S&P is looking much better. Now, if we get a cross above 3,000, that will be above the upper moving average, and that will be a break above the 200-day moving average, which I think will be very important. Here's the NASDAQ. Again, these are the monthly charts that we're looking at. This is on a month-by-month basis. NASDAQ looks the best. There's just no question about it. Now, it's because technology is ruling right now. Technology is where you have good balance sheets. You've got a lot of cash. Some of these companies have a tremendous amount of cash, such as Apple. I mean, we all know about the amount of cash that Apple has. You want to really pay attention here to the quality of the company. So to me, I want to be investing in companies that are profitable. Not necessarily paying a dividend, just profitable where their cash flows are building and their balance sheet is strong. This, like I say, this is a stock picker's market. Here's China looking actually pretty good. China next to the NASDAQ is probably one of the stronger groups. All right, now this is really impressive. This is the aggression index. This is where we're taking the NASDAQ divided by the consumer staples. In other words, technology divided by toothpaste stocks. In other words, aggressive growth versus defensive. And when the line's going up, it's saying that people are being aggressive. In other words, the NASDAQ is really outperforming pretty much everything. Now, this is on a daily basis. This is the 50-day moving average. Strong upturn. In this particular ratio hitting a new high looks pretty strong. Now, here's on a weekly basis, where we look for that lower moving average, which is a 40-week moving average, to turn up, which it has done. So everything that I'm looking at, meaning the data, is telling me the market is put in a bottom and we're resuming a bull market. Every day is different. We'll have to see what happens down the road, but right now, that's what the data is telling us, and I think you got to take this a day at a time. Now, on interest rates, these are our 3 economic factors that we're looking at. On 10-year Treasury note, again, I did want to mention I've got the 200-day moving average up here, which I think is a meaningful moving average. Interest rates are just moving sideways. We're at 0.68 on the 10-year. There's still a lot of talk going around about the Fed going to negative rates. I hear the Bank of England may go to negative rates. But the point being is, it looks like to me that interest rates are just moving sideways. Now on oil, which is West Texas Intermediate, we are seeing some improvement there. And, we're back over $30 a barrel, which if y'all remember, went negative on the May contract. But anyway, on the outgoing contract, we're back up to $33.49 on the barrel of oil. Small caps, again, we are seeing somewhat of a resumption of an uptrend, but like I say, there's a lot of underperformance there. Now, this is worrying me a little bit. This is the put-call ratio. Now, why is this important? This is important because large mutual funds, large funds can't go to cash. They just can't do it because they don't have the liquidity to do it. So what they do instead, and they do go to cash somewhat, and they reposition their portfolios and so forth. But what they also do is they buy options to hedge their portfolio. So if they feel like the market is going to get a lot of upside, getting excited about the market, things look good, you get a lot of call buying. Whereas if there's a lot of pessimism, you get a lot of put buying. So back, around March 23rd, we got this extreme reading of fear, but we're actually creeping our way back into greed. So I would say that if you've got some stocks in your portfolio that you're uncomfortable with or something that's just not working right, I think I'd lighten up a little bit here. In fact, yesterday we did lighten up in one position, but we're not going to go out and wholesale sell everything. I'm just simply saying things are getting kind of frothy here. Just be aware of it. Okay, now on the 25-day, 50-day moving average on the S&P, you can see it, like the NASDAQ, is on a golden cross. We're going to look at a study here in a few seconds that will talk a little bit about that. Here's the 200-day. You can clearly see a break above 3,000 on the S&P would be a break above the 200-day for the first time since February. So that's a key area. I would keep an eye on it. New lows on the New York Stock Exchange kind of drying up here. We had 7 yesterday. Not a problem. You can see what happened, though, back in March. Man, the new lows just went through the roof. Now, let's look at this study that I did. Now, this is 1998, 2002, 2009, 2011, 2018. These are past studies. Now, one thing to understand about a bottoming process, it's not you make a bottom and then it's up to the straight through the roof. That's not going to happen. There's going to be a lot of volatility because of all the uncertainty about the economy. Are we getting stronger? Are we getting weaker? Is there a vaccine? All that kind of stuff. So what we did is we went back and looked at 5 bottoms, and we found out that if you waited till the next peak in the market, in other words, you made the low, and then down the road the market peaked, on average the gain was 51.06%. So finding the bottom and getting invested is definitely a worthwhile enterprise. So you can see here, this is 1998. The market made a low. Now, what I've got here, to make sure you understand, I've removed the price of the index. There's no daily price of the index. All I have on here is the 25-day moving average, the 50-day, and the 200-day, looking for a pattern. Well, here's the pattern. You make the low, you get the golden cross, so this is S&P 500, and then you've made your bottom. That's basically that simple. All right, here we have 2002. Same concept. You made the low, you got the golden cross, you put in your low. Third year that we're looking at, this would be 2009. Okay, the market makes a low, you get the golden cross, you put in the bottom. Fourth example, this would be 2011. You make the low, you get the golden cross, good things start to happen. This is 2018, which was fairly recently. You make the low, you get the golden cross, good things start to happen. Now here's where we are right now. This is like I say, the bottoming process will be volatile. It's not going to be straight out of here. Just remember that experienced investors do look at these things. They look at these charts. And experienced investors don't get into forecasting or predicting. They just simply say, this is where we are today. This is my reference point. This is how I'm going to handle things. So right here you can again see we made our low on the 23rd. We're getting the golden cross. If history repeats itself, good things are going to happen. So be patient. Let's look at the top 5. Now, yesterday we sold our position in Dexcom mainly because we had a very nice profit in the stock. It is somewhat rolling over. The rule is on this particular sell signal is that if the discipline of the stock or the normality of the stock, or what they call porosity, if porosity is around the 10-day moving average and then you close below the 10-day, which it barely did, then you take the low for that day, and then if you break below that low, that is what we call a violation. So you get a break and a violation. You know, being that I'm also seeing some frothiness in the put-call ratio, I went ahead and lightened up there. This is Moderna. This is a very risky stock. Got to be frank with you, this is a one-trick pony. They potentially have antibodies that are working for the virus, so for their vaccine. A lot of news, a lot of traders in this stock. Just be aware of it. It has moved from around $20 a share up to it got up to 87. So it's had quite of a move, but it continues to make our list, so we continue to watch it. Nvidia, which announces earnings today, stock has broken out, looks pretty strong. However, a little bit extended, a lot of white space in here, but it's a very good company. We'll see what happens. Shopify continues to act well. Like I say, look at that porosity. In other words, what porosity is what's normal. Does the stock tend to follow the 10-day? Does it tend to follow the 50-day? Does it tend to follow the 25-day? So what we do is we break it down to the 10-day and the 50-day. And Shopify has been religiously following the 10-day. So if it breaks below it, it just kind of tells you, gives you a warning saying, this is not as normal as it should be. It's just about probabilities and possibilities. Zoom Video, another interesting stock that's been doing really well. Again, back and forth around that 10-day, so been pretty volatile. But anyway, keep an eye on Zoom Video. So anyway, that's it. Let me know if you have any questions. Thank you very much.